to business. My next guest has built the single largest real estate platform in the world. It spans 5 continents, is cross-category, hotel, office, retail, and industrial properties. Blackstone is the biggest homeowner in the U.S. John Gray, the person leading the global real estate division, I asked him where and how he is finding value.
So what we like to do is buy it, fix it, sell it. Try to find income-producing real estate that has something wrong with it, where we can come in with our team and capital, fix it up, and then sell it to the right long-term owner. And this building's a great example of that. If you look at this building today, you're seeing new capital come in, new space like this, where creative tenants can come here. If you look before we bought it, it was in poor physical condition. The offices were sort of dark and dingy. And today we're changing that. And we're not just doing it here. We have 3 other buildings in the adjacent area where we've spent hundreds of millions of dollars, bringing in new retail tenants, redoing lobbies. It's great for the neighborhood, it's great for the tenants, and it's great for our investors as well.
How do you see us in the current cycle?
So I know people are quick to say, oh, we're back in 06, 07, it's a bubble. I would say on the leverage side, that's not the case today.
So when you do the buy it, fix it, sell it, obviously you have potential buyers in mind. And some have said Blackstone is almost at this point like a wholesale to client. So who will eventually be the buyers?
Well, everything's a little bit different. For a building like this here in New York City, once you lease it up, I think it'll be a long-term institutional owner. Could be a pension fund or a commingled fund who wants to own this for a long period of time. Could be a public REIT. For some of the businesses, like a Hilton Worldwide, the public markets are the best exit. So it depends on the geography, the asset class, and we don't always know who's going to be the buyer, but we know if we find a great business, we invest the right capital, we bring in the right management, there should be a home for that asset or business over time.
So to what extent do you see marquee properties, because I know you have invested in quite a few, as being attractive to foreign investors? There is one hotel you recently sold to a Chinese investor. To what extent do you see foreign buyers, whether it's China, whether it's sovereign wealth funds, whether it's any form of foreign capital coming to the U.S.? How much is that driving your strategic decisions?
Well, there's no question that there are large pools of capital around the world who look to the United States and say, we'd love to own great assets in these markets. By the way, it's true in places like London and Paris and Tokyo as well. That's a real phenomenon that I think will continue. Part of that's being driven today by the very low level of interest rates that are out there. But part of it is that real estate fundamentals in most markets are pretty good. There's generally not a lot of new supply. Economies are gradually recovering, and so rents and occupancies are growing. And for investors who want to own assets for the long term, high-quality real estate in great cities has a real attraction to them.
So for all the people who are panicking right now and saying maybe the U.S. is slowing down, you're saying, listen, there are still attractive properties that if we at Blackstone buy, hold for 7 to 10 years, this is going to be a great return for us and our investors.
Well, what I'd say is today, certainly in the public markets, the volatility seems maybe a little bit overdone given the underlying fundamentals. The U.S. economy today looks pretty good. Energy prices have come down, the housing market's starting to come back, technology's strong, banks are in pretty good shape. The core U.S. economy is growing nicely, and that's positive for commercial real estate. And then on the supply side, new supply of real estate still in the low 1% range, so the fundamentals are good. I think that means it's a good investment environment. It's not as good, however, as what we saw 3 or 4 years ago when there was lots of distress, when the banks weren't lending at all, and you were buying assets very inexpensively. So we think we're sort of firmly in the middle of a cycle here. We do think the returns can be interesting, and in particular, I think the public markets have been probably overreacted in terms of their concerns about Fed raising rates, China, those sort of things.
How do you see, let's just say, compare first the U.S. compared to China?
China is coming off very strong growth, not just for a year or 5 years, but really 20 years, and their growth has been phenomenal. But they have challenges in that they've relied heavily on investment-based growth, real estate and infrastructure, and also on exports. And they really want to grow their consumption side of the economy, their domestic economy. And that transition is hard. And you're seeing that in a number of the businesses. You're seeing that in commodity results today. And so there is a slowdown underway. I think, though, people are painting this with a really sort of one brush. And the reality is a little more subtle than that. If you look at the consumer in China today, they're still spending. If you look at Nike's results or Apple's results, they've been pretty darn good. We own 29 shopping malls in China. Same-store sales were up 15% so far this year.
But with the 29 shopping malls, obviously you have a core optimism that those assets will perform well. You also, speaking of emerging markets, have a big investment in India. What is different between those two markets? How did you make that decision to be present in India?
Well, first I'd say on China, part of our optimism is we're focused on the middle market. So H&M anchored, Walmart anchored centers, that feels pretty good. The luxury market is very weak. Transitioning to India, whereas China we think is in a slowdown mode, India is picking up. And part of that is they've made some good, we think, choices on the political side. The prime minister there is pro-growth, pro-economic activity.
It's the biggest democracy in the world?
Biggest democracy in the world. They also have a central banker who's focused on getting inflation down. Interestingly, both China and India have over 1 billion people, but China's economy is 5 times the size of India. There's a lot of potential in that country. We think they're starting to realize on that. Back in 2011 and 12, when everyone got very negative on India, we started going and buying office buildings, big campuses. We're now the largest owner of office buildings in India, and what we're seeing is terrific tenant demand. But a market like that, when it gets really distressed, like it was 3 or 4 years ago, creates opportunities. And as investors, I think that's what we've got to look for. When everybody turns negative on something, that's often when the best opportunity exists.
John Gray has built a one-of-a-kind business. It is also the largest. I asked him how big is too big and how he keeps tabs on $100 billion worth of assets. That answer next. He's responsible for $100 billion in real estate assets across 5 continents. Blackstone's John Gray runs the single largest real estate platform in the world. I asked him if being the biggest operator is ever a detriment, if any organization that large is doomed to fail. Here's what he told me.
We always remember what our business is, which is delivering great returns for investors. And that starts with investment discipline. And then overlaid on that, there's an entrepreneurial spirit to the place, which is where is there a new opportunity? Is it in Japanese residential or pan-European logistics or US retail because everyone's negative about the internet? There's a push to find things both in terms of time or geography that are different. And you've got to promote people who share that sort of drive and energy.
As far as internet, you said that. I have to come back to this, especially where it concerns Europe. I was just listening to Airbnb's founder say they have 80 million listings now worldwide. So this is a huge number. It's up something like 8 times since 2012. What does this mean when you think about Hilton or any of the other properties that you work on in the hotel space?
So I think what Airbnb has done is incredibly innovative, and I think they're going to be a major player for a long time to come. That being said, the hotel business is still very strong, and there's room for, I think, multiple players, multiple forms of distribution. If you look at Airbnb specifically, it tends to be virtually all leisure-oriented, tough to get business travelers in that model to stay in homes and apartments. It also tends to be quite focused in markets where there's very high room rates. You're not going to go to a small town. You're less likely to do that where the room rates in the hotels are low. So its focus and impact's greater in certain places. And I just also point out as a general matter, the U.S. hotel industry, highest occupancy right now it's ever had in its history. So despite phenomenal growth of Airbnb, the hotel industry is doing really well. We think branded hotel companies have a big way to go. Hilton in particular today has 720,000 rooms, but it's got another 250,000 rooms in its pipeline. It's growing very quickly, as fast as it ever has. So I think Airbnb is a real force, but I think this is a big industry with very bright prospects.
As far as taking a bigger picture, just the way that technology is changing every single business. So we just talked about how technology is changing the hotel business, at least as far as consumer and leisure travelers. How do you see it as far as commercial space? I mean, do companies need as much physical space as they did in the past?
So that would be one negative potentially from technology. If you think about the old days at a law firm, they had books and cases and storage files. That's all disappeared. It's all gone up to the cloud. So that's a negative, that densification of storage, but also of people. It's just easier, and a space like this will end up being much more open than traditional office space. On the positive side, though, there seems to be this re-urbanization trend where people are coming back into cities. You don't have to go out to northern New Jersey and have some whopper supercomputer. You've got a device in your hand that has more power than that device had. And so you're seeing in markets like New York City, lots of companies coming back in. It's happening in Chicago as well. Just to give you a sense, in northern New Jersey today, the vacancy rate's something like 24% for office buildings. In Brooklyn, it's 6%. The rents in Brooklyn are 2.5 times as high. So companies, people want to work physically together, but they're choosing now to do more in urban areas. Same thing in Chicago. We bought the Willis Tower, the second tallest building in the US. Part of that's because we're seeing tenants move back downtown, companies like Walgreens, United, and that trend seems to be accelerating. So I think technology's changing things, but people still need to work together.
Blackstone's global head of real estate, John Gray. We have more after this.